The mortgage payment had already cleared when he opened the retirement account statement. It was the same routine he had followed for years. The first week of the month meant fixed obligations first: mortgage, insurance, utilities, the automatic transfer to savings. The checking account balance would settle into its familiar post payment number, lower but predictable. Only after that did he look at the long term accounts. The house was purchased 12 years earlier, in his late 30s, when stability felt like the central objective of adult life. He and his spouse had been renting a two-bedroom apartment near the city, close to work but short on space. The decision to buy was measured, cautious, framed around permanence. A fixed rate 30-year mortgage, a conventional loan, 20% down, nothing speculative. The monthly payment fit within underwriting standards. It left room for groceries, childcare, health insurance premiums, and a modest contribution to a 401k. On paper, the numbers worked. The house appreciated steadily in the years that followed, not dramatically, but reliably. Property taxes rose in small increments. Homeowners insurance ticked upward. Maintenance costs appeared as expected: water heater replacement, roof repair, HVAC servicing. The mortgage itself became the most stable line item in the household budget. Through job changes, performance reviews, and minor economic cycles, the payment remained fixed. It was dependable in a way few other financial elements were. Salary adjustments varied year to year. Health insurance deductibles increased, school expenses shifted, groceries became more expensive, but the principal and interest line never moved. He took quiet comfort in that. Colleagues refinanced during lower rate periods, shaving points off their interest, extending terms, resetting amortization schedules. Some extracted equity to remodel kitchens or consolidate debt. He chose not to. The original loan felt disciplined, predictable. It was structured around a finish line he could see decades away. At 45, the mortgage was still there, but the retirement account had grown enough to feel substantial. Employer matches accumulated. Market gains compounded unevenly but generally upward. He tracked the balance less frequently than before. There was an understanding that time was now doing some of the work. The house, meanwhile, required steady attention: landscaping, appliances, small structural fixes that never appeared in mortgage brochures. These costs were manageable, but they were continuous. Ownership did not escalate dramatically, it simply persisted. The realization did not arrive all at once. It began as a subtle arithmetic observation while reviewing amortization tables. Even after 12 years of payments, a significant portion of the original principal remained. Early years had been weighted toward interest. The equity built through market appreciation exceeded the equity built through principal reduction. He noticed that the mortgage would not be fully paid until he was 67. The number did not alarm him immediately. 67 aligned roughly with Social Security's full retirement age for his cohort. Many professionals planned to work into their mid to late 60s. The timeline seemed consistent with broader patterns. Still, the coincidence lingered. His retirement projections had previously centered on age 62 or 63, an early but plausible exit from full-time work. The spreadsheets he had created in his early 40s modeled scenarios where investment balances, combined with reduced expenses, might allow flexibility before traditional retirement age. Those projections assumed the mortgage would either be minimal or gone. He had not fully accounted for the way a fixed 30-year term anchors more than a housing cost. It anchors a working horizon, a required income floor. a structural commitment that extends through peak earning years and into the edge of retirement. The payment itself was not excessive relative to income. It never had been, but it was non negotiable. Unlike discretionary spending, it did not contract in response to fatigue or shifting priorities. It was due whether enthusiasm for work remained or not. Around age 50, conversations among peers shifted. Promotions plateaued for some. Younger managers entered departments. Corporate restructurings became more frequent. The labor market, while stable overall, felt less predictable at the individual level. He began to notice subtle career fatigue. Not burnout, not crisis, but a diminished appetite for long term corporate navigation. The house, once a symbol of arrival, had become background infrastructure. The mortgage, still fixed and stable, functioned quietly as an employment requirement. Property values in the neighborhood increased steadily. On paper, the household net worth strengthened. Real estate websites estimated the home's value significantly higher than the original purchase price. Neighbors who sold realized substantial gains. Yet, selling was never purely financial. It meant relocating, adjusting commutes, potentially downsizing. The children were in high school. The district mattered. Stability, once chosen deliberately, reinforced itself. He reviewed the retirement account again one evening after the mortgage cleared. The balance had grown meaningfully over the prior decade. Market cycles had included downturns, but long term performance remained positive. Still, when he modeled a retirement at 62, while carrying 5 more years of mortgage payments, the monthly cash flow tightened. The mortgage did not disappear in retirement models unless he extended work. It became clear that the 30-year term, chosen conservatively in his late 30s, effectively synchronized with full retirement age. The structure was not accidental. Lenders and borrowers alike operate within a cultural expectation that income persists through the working years. He had never framed it that way before. Friends who had opted for 15-year mortgages paid higher monthly amounts earlier, but eliminated housing debt by their early 50s. Their peak earning years were heavier, but their later years carried fewer fixed obligations. Others, who purchased smaller homes or remained renters, had different timelines entirely. His path was stable, moderate, reasonable. It was also binding. The house itself had become integrated into identity. Family gatherings, incremental renovations, familiar creaks in the floorboards. It was not an asset in daily life, it was environment. The mortgage statement, however, remained external. An obligation mailed or emailed each month, detached from emotion. The long-term consequence of stability revealed itself gradually. Flexibility was reduced precisely when optionality became valuable. At 55, he ran updated projections. Retirement accounts had crossed a psychological threshold. The balances looked sufficient to support a modest lifestyle with careful withdrawals. Healthcare costs before Medicare age created a gap. So did the remaining mortgage term. Working until 67 eliminated those gaps comfortably. Leaving earlier required compromises, either higher withdrawal rates or liquidating home equity. He considered the equity. The home had appreciated significantly. Selling could free capital and eliminate the mortgage simultaneously. Downsizing to a smaller property in a lower cost area would reset the housing equation. Yet transaction costs, capital gains considerations, relocation logistics, and emotional attachments complicated the picture. The stability he had pursued in his 30s now required disruption to unwind. During annual performance reviews, he began to think less about advancement and more about endurance. The mortgage payment, though unchanged in nominal terms, represented continuity of employment. Each month paid was 1 month closer to ownership without lien, but also 1 month deeper into a career he no longer felt compelled to extend indefinitely. There was no crisis, no financial mismanagement. The decision to buy had been responsible. The interest rate was competitive for its time. The payment had never strained the household budget. In fact, compared to rising rents in comparable neighborhoods, the mortgage appeared advantageous. But rent, while subject to market increases, does not bind for 30 years. Ownership provided equity and price stability. It also set a horizon. He observed that his thinking about retirement shifted from aspiration to synchronization. Instead of asking when he wanted to stop working, he asked when the mortgage would be gone. The two dates converged naturally without explicit planning. The coupling felt subtle but firm. Colleagues who had no mortgage discussed part time consulting in their early 60s. Others who had relocated to lower cost regions described reduced financial pressure. He listened, calculating internally how many payments remained on his amortization schedule. The house required a new roof at 56. The expense was significant but expected. Insurance covered part of it. The remainder came from savings earmarked for maintenance. He did not resent the cost. It was consistent with ownership. Still, it reinforced that the mortgage was not the only housing related outflow. Retirement contributions continued automatically. Market returns fluctuated. He reduced equity exposure slightly as he aged, not out of fear, but sequence awareness. The portfolio composition became more conservative. Growth slowed accordingly. The mortgage remained constant. At 60, he reviewed the outstanding principal. The balance had declined meaningfully. Interest now comprised a smaller share of each payment. The psychological weight of the loan lessened as the finish line approached. Yet the working years remaining matched the amortization schedule almost exactly. The realization, when fully formed, was quiet. The house had determined the length of his career more than any formal retirement target. Not because it was unaffordable, but because it was structured to conclude at traditional retirement age. The mortgage did not force him to work. It simply aligned neatly with the period in which full-time income was culturally expected. In his early planning years, he had framed the 30-year term as conservative. Lower monthly payments meant higher liquidity. Higher retirement contributions were theoretically possible because housing costs were manageable. Over time, however, lifestyle inflation, education costs, and healthcare premiums absorbed much of that margin. The extended term did not dramatically increase monthly strain. It extended obligation duration. By 62, the original aspiration age for retirement, 5 years of mortgage payments remained. The amount was not catastrophic relative to savings, but eliminating it early required either a lump sum payoff or continued employment income. He continued working. There was dignity in that. Colleagues valued his experience. The income supported not only the remaining mortgage, but also continued retirement contributions, reducing pressure on investment withdrawals. Social security benefits increased with delayed claiming. The structure again worked. At 67, the final payment cleared. The mortgage statement arrived with a zero balance. The lien release paperwork followed weeks later. The house, fully owned, stood as a tangible artifact of decades of steady payments. No dramatic celebration occurred. The day passed like most others: email, meetings, routine errands. Retirement paperwork was filed shortly after. The timing appeared orderly from the outside. A career that concluded at full retirement age. A home paid off precisely as employment income ceased. Retirement accounts sufficient, social security benefits maximized. It resembled a model case of financial responsibility. Only in retrospect did he see how closely the 30-year mortgage had mapped the arc of his working life. The choice that prioritized manageable monthly payments in his 30s quietly defined the endpoint of his full time employment in his 60s. The house provided stability, appreciation, and a controlled housing cost during volatile rental markets. It also extended the period in which steady income felt necessary. There had been no mistake, no miscalculation, no crisis, just alignment. The mortgage, once a symbol of security, had functioned as a long duration contract between present comfort and future timing. It reduced early strain and preserved liquidity. It also synchronized retirement with traditional age rather than personal readiness. In the final months before retirement, he walked through each room with a different awareness. The house no longer represented something being paid for. It represented something fully integrated into a life that had unfolded alongside it. The payment that once dictated the first week of every month was gone. The career that supported it ended almost simultaneously. The structure held from beginning to end.